Let's cut right into it. The ULTY ETF has been one of the hottest names in the high-yield investing space in 2025. People can't stop talking about it, not because it's a traditional dividend fund, but because it's paying out weekly income at levels most investors never imagined possible. But along with the hype comes the controversy. ULTI has developed a reputation for something called NAV erosion, and that's got a lot of investors wondering whether they should continue holding or if it's time to sell before their capital slowly disappears. So in this video, let's break it all down. What ULTY really does, why the yields are so high, what NAV erosion means for your portfolio, and ultimately, whether ULTY is a hold or a sell in 2025. So what exactly is ULTY? It's part of the Yield Max lineup of option income ETFs. It's a multi-stock fund, holding U.S. large-cap names across different sectors with a focus on high-volatility companies. The whole point of this ETF is to generate outsized income by using a covered call strategy. That means ULTY holds these stocks and then sells options on them every week. The option premiums get collected, and that money is paid out to investors as weekly distributions. Now here's where the appeal comes in. ULTY has been paying out at a trailing distribution rate of over 89%. That's not a typo. We're talking nearly 4 times what some of the best monthly dividend ETFs produce. And unlike those funds, ULTY pays investors weekly. For income-hungry investors, it almost feels like getting a paycheck from your brokerage account every single week. But high income doesn't come without trade-offs, and this is where NAV erosion enters the picture. If you're new to the term NAV, it stands for net asset value, basically the per-share value of the ETF's underlying holdings. Every time ULTY makes a distribution, it reduces its asset value by the amount of that payout. That's normal for any dividend fund, but because ULTY pays such large distributions week after week, this reduction happens at a much faster rate than with traditional dividend ETFs. Think of it like this. If a fund pays out 3% per year, net asset value barely feels it. But if a fund pays out over 89% annually, net asset value takes a beating, and fast. This is exactly what investors have been noticing with ULTY. The share price has drifted lower over time, even as distributions remain strong. That's what people mean when they talk about erosion. Your income looks fantastic on paper, but your actual capital base is shrinking slowly beneath it. So is that a deal breaker? Not necessarily. It depends on what you're using ULTY for. If you're investing for long-term growth, value erosion is a serious problem. Over several years, your initial investment may not hold its value. Even if you're getting big payouts along the way, the actual fund value might decline. That's not something growth-focused investors want to see. But if you're investing purely for income, say you're retired or semi-retired and want weekly cash flow, net value erosion might not matter as much. You're trading off growth for income. As long as the fund keeps generating option premiums and paying distributions, the income stream keeps flowing. It's less about preserving your principal and more about maximizing the cash you're getting today. This brings us to the big question. Should you sell or hold ULTY? Let's walk through both sides of the argument. The case for holding ULTY is simple. The income is unmatched. A high trailing yield and weekly payouts put it in a completely different category from traditional ETFs. Investors who are comfortable with the risks might argue that even if the NAV drifts lower, the sheer amount of income offsets it. For example, if you invest $10,000 and collect $8,900 in distributions over the course of a year, does it really matter if your asset value drops by a couple $1,000s? You're still far ahead in cash terms. There's also the reinvestment angle. If you drip, meaning you reinvest those weekly dividends into more shares of ULTY, you're compounding faster than with almost any other ETF on the market. Weekly compounding can add up quickly, and some investors see this as a strategy to fight erosion by stacking more and more shares over time. Now, the case for selling ULTY is also strong. The main argument is sustainability. Critics worry that ULTY's distributions are simply too high to last long term. If NAV continues to erode and the underlying stocks don't perform strongly enough, the option premiums may shrink over time, and that could force YieldMax to lower distributions. And when a fund with this much hype cuts its payout, the share price could take a steep hit. Another reason some investors sell is because they view ULTY as a trading ETF, something to own short-term for high income, but not a long-term core holding. If you already captured several months of strong payouts, you might decide to exit before the erosion worsens or before broader market conditions change. So, where do I land on this? Well, for me, it really depends on how you frame ULTY in your portfolio. If you see ULTY as a replacement for a dividend growth ETF, I'd say you're probably setting yourself up for disappointment. ULT isn't designed to grow over time. It's designed to spit out income. So in that sense, it's more like an income engine you rent, not an asset you own forever. But if you're using ULTY for what it's built for, high frequent income, then holding it makes sense. The key is position sizing. You don't want 100% of your portfolio in a fund with this kind of risk profile. But allocating a slice, maybe 5 to 15% of your capital, specifically for income, could be reasonable as long as you understand the trade-offs. Another thing to consider is monitoring. ULTI isn't a set-and-forget ETF. You should keep an eye on the NAV trend, distribution announcements, and any changes YieldMax makes to its strategy. Earlier in 2025, they already adjusted the fund to balance stock holdings and derivatives more carefully, specifically to slow down the erosion problem. That shows they're aware of the issue and actively working on it. Ultimately, ULTY is what I'd call a use case ETF. If you need cash flow now and you're comfortable with the risk, it could be a hold. If you're looking for stability and long-term wealth preservation, you might be better off selling and shifting to a lower yield, higher stability fund. One last thing before we wrap up. Don't get blinded by yield percentages alone. An 89% yield looks incredible, but you have to ask yourself whether that income lines up with your goals. If NAV erosion eats into your gains faster than you expect, the math might not look as good as the headline yield suggests. So, to sum it up, ULTY is a fascinating ETF that has carved out its niche by offering extreme weekly income. For some, that makes it worth holding. For others, especially those worried about NAV erosion, it could be a sell. The decision really depends on whether you're chasing income today or trying to grow wealth for tomorrow. And with that, I'll turn it over to you. Would you sell or hold ULTY in your portfolio? Drop your thoughts in the comments below and let's see where the community lands on this one. And if you found this breakdown helpful, don't forget to hit that like button and subscribe to Money Stick Unfiltered. We're here every week breaking down ETF dividends and the latest income strategies in plain, simple language.